The travel sector in 2020 got absolutely destroyed. We saw some of the largest names drop 70, 80, 90% in share price in a matter of weeks. But there is a little bit of recovery hope for 2021. With vaccines getting approved and vaccines ready to be distributed across the United States, there is some hope for the travel industry to rebound over the next calendar year. And in this video today, we're going to go over 6 different travel names that have the potential to see some massive upside if the overall industry comes back. Of course, this is still a very, very high risk sector of the market, and there's still a huge potential for these shares to see a massive decline. But we're going to go over 6 different companies where if we see an overall bump up in travel and it becomes safe to travel within the United States and internationally, these are some of the big name brands that are expected to see some massive share price growth. So we're going to go over 6 different travel companies, and we have variety on this list today. I'm not going to discuss just 4 airlines and 2 cruise lines. We have a lot of diversity. We have an airline, a cruise line, an entertainment and theme park company, as well as a hotel and casino company as well. So we have companies that all operate based on travel, but in different areas of the overall sector. Before we jump into the travel stocks, if you're new to the channel, everyone, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell within your own portfolios, and of course, we go over any major stock market news and headlines. So please hit the like button and subscribe to the channel for daily videos about the market, and we're going to continue on with this video focus on 6 travel companies that may see some rapid growth in 2021. And the first company in today's video is ticker RCL, Royal Caribbean Group. Of course, this is one of the largest cruise companies in the world, and they currently trade around $76 per share. Before we kind of deep dive into RCL, I want to make it very clear that none of these companies in today's video are any recommendations. Of course, you all know I'm not a financial advisor, and this is just my overall opinion on a very high risk sector of the market that may see some upside if travel comes back over 2021. So RCL is down 38% this year, and on the 5-year chart, the company is down 16%. And you can see before the pandemic, slight upward trend over the past 3 to 4 years with a major decline back in the month of March. They currently trade at a market cap at around 17 billion and are trading in the low side of the 52-week range. But from the 52-week low at $22 per share, you can see they've already done a nice job of climbing back up. Royal Caribbean is the largest cruise line with regard to revenue in the world. And the company controlled, pre-pandemic, more than 20% or around 1/5 of the global cruise market, which is absolutely incredible. They were the market leader, and that happened because their customers loved their services. They had a ton of repeat customers, and as of right now, their loyalty program currently has more than 20 million members. And they also initiated a program back in August during the height of all the cancellations called the Remarkable Bookings. And it showed that 60% of their 2021 international cruises are bookings for entirely new cruises rather than just rescheduled ones from this year, which just shows there's a lot of their customers who are optimistic for cruises in 2021, and 60% of their bookings are actually newly initiated vacations. Now we're quickly going to go over Royal Caribbean's total income statement and balance sheet numbers from pre and post pandemic, just to get kind of an idea of how hard they've been hit. So you can see total revenue before pandemic was growing each and every year. And in 2019, they posted close to 11 billion of total top line revenue. Compare that to the past 12 months of only 4.69 billion, you can see a decline of more than 50% in total revenue. Now if we compare that to the bottom line, they were actually profitable for 4 to 5 consecutive years as revenue was growing. But now in the past 12 months, over $4 billion net loss from RCL. So of course, we all know the pandemic has destroyed this industry as of late, but when you take a look at the numbers, it is worse than expected. If we take a look now at the balance sheet, right now they have total current assets at $3.5 billion. Compare that to total current liabilities at around $4.6 billion. So a current ratio below 1, currently sitting at 0.75. So over the short term, they will need to raise some capital either through debt or selling shares just to get enough money to pay off their short-term liabilities. So RCL, one of the leaders in the cruise line space, of course has been shut down this year, but over the past year, from the March lows, we have seen a slow but consistent upward trend in the share price. Still nowhere near the 52-week high, but overall this company is a market leader, and if the travel sector can recover, it is safe to go on cruises. This is going to be one of the name brands that I think is only going to grow. They have strong customer brand loyalty, and I think once it's safe to do so, whether it's in 2021 or beyond, this company will see a massive recovery. Moving on to stock number 2 in the travel space, we have Southwest Airlines. Ticker LUV, currently trading around that $45 range. The shares are down 15% this year. Over the past 5 years, though, the shares are up still 5%, and the company currently has a market cap at around $27 billion. Trading in the center of the 52-week range, this is one of the main 4 airlines that gets talked about all over the financial news. But if we take a look at what Morgan Stanley likes, they chose Southwest as the leader in this industry. They believe the overall airline industry, of course, can recover if we see an overall, vaccine production and distribution across the United States and internationally. And if it becomes fully safe to travel, they believe all airlines are going to succeed, but their top pick actually comes to Southwest Airlines. They have upgraded the company to overweight and have a price target set at $54 per share. And if we take a look right now, sitting at $45, still some upside potential if they can hit this analyst price target. So we all know airlines have been shut down, slowly reopening as the pandemic continues to grow still. Total revenue for this company has been absolutely destroyed. Similar to Royal Caribbean, you can see growing revenue each and every year before the pandemic, massive decline down to around $12.7 billion over the past 12 months. Similar idea with regard to net income, profitable for each and every year pre-pandemic, with a massive decline in a net loss of around $1.6 billion. But if we take a look, this is still the one airline that analysts still see some upside potential with. On the scale of 1 to 5 from Yahoo Finance, it is ranked right at a 2.1 in that buy rating, and the average price target from Yahoo Finance shows a $50 price for this stock. So it's actually above that $45 price where we sit today. So still some short-term momentum and some short-term upside potential in Southwest Airlines over the next 12-month span. Now we're going to move on to stock number 3. We're done with airlines and cruise lines. Those are the 2 companies that try to get all the hype with regard to travel, but I believe there's so many more different companies in that industry that can see a benefit. And the third company we're going to discuss is Disney, currently trading at an all-time high at $175 per share, up 19% this year. So Disney's a very interesting company. Of course, they have their theme parks, which are more of the travel-based part of their business, but they have other aspects such as their entertainment and streaming platforms that are growing dramatically, leading to this rapid surge in share price. I've been discussing Disney on this channel for months. I think the company had a lot of upside back down in that around $120 range months ago. And Disney has been climbing as of late, reaching a new all-time high with some major new announcements from their Investor Day presentation. Even though they're having problems opening up their theme parks because of the pandemic, and across the world, theme parks are either shut down or opened with limited capacity, their theme park revenue has been decimated. But their streaming platforms are making up for that. They have some of the fastest growing platforms in the world. They're expected to be the streaming leader over the next 3 to 4 years, and they have set record-breaking numbers from Disney+. Currently, they have over 86 million paid Disney Plus subscribers, and that is only expected to grow to over 260 million by 2024. And although Disney is trading at an all-time high right now, analysts believe the share can go even higher. They're expecting another 30% surge in share price to a price target of around $200 compared to where they sit right now at $175. And I think Disney is still a massive player in the travel space. Once the pandemic is over and they can operate all their theme parks at full capacity, bring back that huge revenue stream for the business, plus the new surge they've seen in their streaming, I think Disney can be a powerhouse for decades down the road. Like I mentioned months ago in previous videos, Disney is a brand that I believe their intellectual property, their characters are too strong to disappear. I think Disney will always be around for many years down the road, and their streaming platform, now that they're making it a key focus of their business, is only going to help them accelerate. Now, in the next few years, when the theme parks can remain back up and operational, I think it's only going to be another growth factor, sending shares much higher than where they are today. Moving on to stock number 4, we have Marriott International. Currently trading at $125, this company is down 10% on the 1-year chart. They currently trade at a market cap at around $41 billion and just above the midpoint on the 52-week range. This company is of course based within the United States, but they are the world's largest hotel chain. They currently operate in 110 countries with over 5,700 properties. They have 30 different brands of hotels, and of course, one of their most popular is the Sheraton. Overall, this company has been growing nicely pre-pandemic, and we all know, similar to every other brand in this video, a massive downturn over this calendar year. But they've done a nice job of innovating. Airbnb just went public on the market, and we saw their shares double in the first trading day. Huge demand for that form of travel and that form of luxurious stay, and Marriott is competing in that industry with their own form of a similar type of style to Airbnb. They have announced and are providing private vacation homes and rentals through their Homes and Villas platform. This is a big competitor to Airbnb because this is different. In this platform, you are not renting a traditional room in a normal hotel. You're renting a private either apartment or villa or an even individual home somewhere in the world. Exact type of business model that Airbnb has. And with Marriott's massive infrastructure, they currently offer over 2,000 homes in over 100 destinations across the world. So they are going to be one of the players that competes with Airbnb through their massive hotel industry. They're just going to transition the traditional, building and construction of normal hotels into more unique and luxurious private homes to compete with the changing demands of the travel space. So I think this Homes and Villas platform is a huge driver of future business. I think that's only going to grow in popularity, and the company has announced plans to grow the number of units available through this platform. So I think I really do like Marriott. I think they have some of the strongest names. They have some of the high-end names as well as some of the cheaper-end hotel stays as well. They're diversified across the world, and once travel picks up, regardless whether it's in 2021, 2022, or beyond, this company may lose some properties, but I don't think they're going to get wiped out at all. And you can see here, they've already seen a recovery as of late, and this may be one of the top brands if you want to get in and take the risk of the hotel sector. Now on to number 5, we have Expedia. Currently trading for $123 per share, this is of course a tech-based travel company. They currently have a market cap right now at over $17 billion, and they operate a marketplace that allows individuals, consumers, and businesses to book hotel stays and flights to almost anywhere in the world. They offer a bunch of different smaller services, of course, all related to how you get to where you want to go, and overall this is one of the main players in the online digital travel booking space. So of course, we all know with hotels going down, cruises going down, there's going to be less people using Expedia to book trips. So if we take a look at their financials, similar to what we've already seen so far in this video. Taking a look at their income statement to start off, we're going to see a similar trend to both the airlines and the cruise lines we've already gone over. Total revenue right now, before pandemic, growing each and every year, setting nice highs. And you can see that trend not including the past 12 months, nicely growing top line. But now, of course, big decline down to $7 billion of total revenue with a massive net loss of over $2 billion over the past 12 months when the company was once profitable and growing their bottom line year over year. So now we're going to finish off with the final hotel and casino gambling-based company, number 7, MGM Resorts. Currently trading at $30 per share, they are down 6% this year, market cap at around $15 billion, and they have seen a nice recovery. They saw a huge decline down to a low of around $7 per share back in the month of March, but now slowly trending upwards back to that $30 point, nearing a new 52-week high. So of course, this company, one of the largest owners of casinos, entertainment, and hotel brands in the world. Of course, they have big presence within Las Vegas and internationally. And of course, similar statements, top line growing beautifully, 50% decline, and now posting huge decline in net income. But one thing I want to point out, this is the only company that was hit extremely hard with a 50% decline that is still profitable. 1.4 billion of net income over the past year, so having posting a net loss is a good sign from MGM. So overall, I think casinos are going to come back. I think people are always going to have that desire to get rich quick, even though the odds are stacked against them. And I think casino just have that kind of allure that will attract people for decades. I don't think that's ever going to go away. And I think MGM is still positioned to be a leader with their strong, recognizable brands. So those were 6 different companies, all within the hotel space. Very, very high risk sector of the market. And like I mentioned before we even got into the picks, I am not a financial advisor. None of this was financial advice. This was just me going over some companies that may grow if we see a strong travel recovery into 2021. So we had companies that were the traditional airlines and cruise lines. Then we had the world's leading hotel chain, a casino brand, an online digital booking, and of course Disney, which has the theme parks and entertainment attractions, plus the streaming service. So I tried to make this list as diversified as possible across the entire travel sector and encompass brands, not only the ones that always get talked about. A little bit of different variety on this list. So thank you for watching and see you in tomorrow's video.